The history of money. Ancient barter systems. Before the invention of money, ancient societies relied on a barter system where goods and services were exchanged directly. This system required a double coincidence of wants. Both parties had to have what the other wanted and be willing to trade. For example, a farmer with surplus grain might trade with a shoemaker for shoes. Early forms of money. Commodity money. To overcome the limitations of barter, societies began using commodities as a medium of exchange. Commodity money includes items with intrinsic value, such as livestock. Cattle and sheep were common in many early societies. Grain staple crops like barley and wheat shells, cowrie shells were used in Africa and Asia. Metals, copper, gold, and silver, valued for their durability, divisibility, and transportability. The use of gold and silver. Gold and silver emerged as the preferred forms of money due to their properties, scarcity, which made them valuable because of their limited supply, durability, as they are resistant to corrosion and wear, divisibility, meaning they could be melted and reformed into smaller units, and portability, making them easy to transport. The invention of coinage. Around 600 BCE, the Lydians in what is now Turkey minted the first coins. These coins were standardized in weight and purity, facilitating easier trade. Coins quickly spread to other civilizations, including Greece and Rome. The evolution of paper money. Early paper money in China. China was the first to develop paper money during the Tang dynasty, which was from 618 to 907 CE. By the Song dynasty, spanning from 960 to 1279 CE, the use of paper money had become quite widespread. The government issued notes that were backed by precious metals and other valuables. European banknotes. In the 17th century, European banks began issuing banknotes as receipts for deposits of gold and silver. These notes could be redeemed on demand for the corresponding amount of metal, making them, well, quite convenient for trade and transport. The gold standard. The gold standard is a monetary system where a country's currency is directly linked to a specific amount of gold. Under this system, paper money could be exchanged for a set amount of gold, providing stability and trust in the currency's value. The gold standard was widely adopted in the 19th century, especially after the establishment of the Bank of England in 1694. Which played a key role in stabilizing the British pound. Post-World War II, the Bretton Woods Agreement established a global gold standard where the US dollar was pegged to gold and other currencies were pegged to the dollar. The transition to fiat currency. Fiat currency is government-issued money that is not backed by a physical commodity like gold or silver. Its value comes from the trust and confidence of the people who use it, as well as the government decree that it must be accepted for payment within the country. The Great Depression of the 1930s led many countries to abandon the gold standard to allow more flexibility in monetary policy. President Richard Nixon ended the convertibility of the US dollar to gold in 1971, effectively ending the Bretton Woods system and fully transitioning the world to fiat currencies. Fiat currency offers several advantages, such as greater control over the economy and the ability to respond to financial crises. However, it also comes with disadvantages, including the risk of inflation and the potential for government mismanagement. Advantages. Flexibility allows governments to manage the economy through monetary policy, such as adjusting interest rates and money supply. No resource limitation, not limited by the availability of a physical commodity. Disadvantages. Inflation. Risk. Governments can print excessive amounts of money, leading to inflation. Trust-based, requires trust in the government and its stability. The advent of central bank digital currencies, or CBDCs. Central bank digital currencies, or CBDCs, are digital forms of a country's sovereign currency issued by its central bank. Unlike cryptocurrencies like Bitcoin, which are decentralized and often anonymous, CBDCs are centralized and regulated by the central authority. There are several reasons for developing CBDCs. Firstly, financial inclusion, providing access to banking services for unbanked populations. Secondly, efficiency, reducing the cost and time of transactions. Thirdly, security, enhancing the security and resilience of payment systems. And finally, monetary policy, improving the implementation of monetary policy. Now let's talk about the types of CBDCs. Retail CBDCs. For the general public, they are accessible to everyone for daily transactions. Examples include the Bahamas' sand dollar and China's digital yuan. Wholesale CBDCs. These are for financial institutions and are used for interbank transactions and settlements. Examples include projects by central banks like the Bank of England and the Bank of Canada. Benefits of CBDCs: speed and efficiency, faster and more efficient payment systems, reduced costs, lower transaction costs compared to traditional banking, financial stability, enhanced control over the money supply, and financial stability. Challenges and risks. Privacy concerns, potential for increased government surveillance of financial transactions, cybersecurity, risk of hacking and cyber attacks, disintermediation, impact on traditional banks' roles in the financial system. The journey of money from barter systems to fiat currencies and now towards CBDCs reflects the continuous evolution of our economic systems to meet the needs of society. Each step from using commodities like gold and silver to adopting fiat currencies and now exploring digital solutions has been driven by the quest for efficiency, security, and stability in economic transactions. As we move towards a future with CBDCs, it is crucial to address the associated challenges to harness their full potential for the benefit of the global economy. We have reached the end of the video. Thank you so much for watching. Hopefully you find it interesting and educational. Don't forget to like this video and subscribe, provided you like the content, of course.